Well, okay, good. Before we start, I wanted to share a few fun facts. Uh, I saw some fun facts about tax. Did you know that Abraham Lincoln gave us tax? He was the one that introduced federal income tax. Abraham Lincoln signed the Revenue Act in 1861, which imposed the first federal income tax on U.S. citizens. So, in case you're wondering how federal income tax came to be. Also, the average American gets about 3,000 back from their IRS tax refund each year. You know, when you get that money, it feels so good. So the average American gets about 3,000, if I'm wrong. Mr. Ben, maybe when you grab the mic, you correct me, but that is the part I got. That average American get about 3,000 back from their tax refund every year. Also, I found another fact. A famous gangster was ultimately taken down over taxes. Who knows the guy? Who knows a famous gangster that was taken down through tax purpose? Nobody? All right, his name is Al Capone. I'm sure you read about Al Capone before. Al Capone is a mob boss. He ran a criminal enterprise and regularly ordered hits on his enemies. He was very famous. But he wasn't sent to prison for murder because they could not trace all the murder back to him. You know, there was always that loyal thing back then when you were in the mobster. So rather than, talk against their boss, they rather kill themselves. But rather than getting him for murder, he was charged with tax evasion and fraud and was sentenced to 11 years. He spent some time in Alcatraz Island on San Francisco Bay. I've been to San Francisco Bay before. I went to Alcatraz because I wanted to see what it was like back then. It was really like when you are there and you have to jump out of the water. I know a couple of people escaped and they swam all the way out to their escape. It's in the middle of nowhere. If you have the chance to go to San Francisco, you should check out the Alcatraz. It's really interesting.
That's why they said follow the money. That's where that term came from. If you money is traceable, but it's difficult to find bodies.
All right, awesome. Thanks for telling us that. All right, moving forward, another fun fact. Even astronauts in space need to file their taxes on tax time or ask for an inspection. Isn't that funny? You are somewhere far away, million miles, and you have to talk about your taxes. It actually happened. Jack Sigwell, the command module pilot for Apollo 13, who joined the crew at the last minute, wasn't supposed to go, so he joined at the last minute. It was mid-mission when he realized he wasn't going to miss the April 15 tax deadline. So he radioed Houston to request an extension. Remember when they say, Houston, we have a problem. So this guy said, Houston, I have a problem. And although the ground crew laughed at what they presumed was a joke, Jack was dead serious. And he told them that, hey, listen, it ain't funny. Things kind of happen really fast down there. And I had to request an extension. And, they had to help him to request an extension. So even while you're in space, you have to make sure you file your tax. That is funny about America. Well, moving forward, even Einstein didn't understand tax. Can you imagine that? One of the most famous pieces of our time and, one of the best brains out there back then. Albert Einstein apparently found tax more inscrutable than theoretical physics. He once said, the hardest thing in the world to understand is the income tax. That is according to Leo Matadov, the math genius tax preparer. So the guy that prepares his tax quotes that he said that, hey, I don't understand how this tax thing works. Just do it for me. And I'll take care of the pieces. Moving on. I think this is the last one. All right, 7 states have no income tax. For some of you that are looking to move or make more money, 7 states have no income tax. 7 states do not have an income tax. Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming. New Hampshire and Tennessee tax only dividend and interest income. Now I see why my favorite cousin moves to Wyoming. Or is it Wisconsin again? Okay, it's Wisconsin, not Wyoming. All right, but I've been fortunate to live in Texas, and I've also lived in Washington. It feels good not to pay income tax, I can tell you that. When you just see that little bump in your salary, you know how that feels. All right, moving forward today. Thanks for hanging in there with the fun facts. Today we have Mr. Ben Azunna. He has an MBA. I forgot to look all these codes, but I know he's an IRS certified auditor. The CFCEA, I will probably want him to explain that. I know CISA. Then he is a 12-year experience in tax resolution, individual and corporate tax preparation. And I can tell you, he is my tax preparer. So I'm like that Albert Einstein, who needs Mr. Ben Azunna to help me to figure out my taxes. So I've been working with Mr. Ben for a while. He was introduced to us by a friend, Shoga Akinro, and Ngozi Akinro, Professor Ngozi Akinro. So she's here with us. So without further ado, I'm going to leave it to Mr. Ben to do justice to the topic today. Thank you very much, sir. Like I introduced him, I will put this up later at the end so that you can grab the phone number, the email address, and you can reach out to him via the website. So like I said, I'll put this up again at the end. Mr. Ben, over to you, sir.
Thank you very much. I concur with all the fun facts that you have listed. Let me add one or two more. And this one, I'm not sure is so fun, but it's a fact that you are taxed while you are living, and to some of us, we may be taxed even when we are gone. So I don't know if you have heard the story about some celebrities, especially when you have royalty and things like that. I mean, they keep taxing your estate even after you things like that.
Oh,
and there's also this one that says the fear of the IRS is the beginning of financial wisdom. So
that is a good one.
Yeah. So it's been said that the three letters that Americans fear the most is IRS. And that is so real that I've seen some people walk into our office with IRS letter unopened. So they are so scared not even to open the letter to know what it is. So those are really facts. But let me take a moment to thank you, Mr. Dayo Yegede and the Bloomberg Group for the opportunity to speak to your audience on this matter. I also want to thank the audience for making our time to be part of this. This is a very an important topic that everyone needs to listen to, especially when it involves about a third of your income. Believe it or not, you may be surprised to hear that about 33% of whatever you make goes on various taxes, and we're going to be talking about that. So it's good to get wisdom even when you think you know some. For those of us who are Christians, the book of Proverbs, talks a lot about gaining wisdom, and not to the dummies, but actually the wise themselves. So I really encourage everybody to seek knowledge, especially when it comes to matters regarding your finances. So we're going to be talking about tax fundamentals for working professionals. And we're going to dive into the basics and then, I'll give more understanding on some of the topics. So at the end, feel free to ask questions on topics covered, or even those that are not covered. Nobody knows it all. There are a lot of codes involved in tax. Somebody described it as about 6 billion pages if you have to print all the tax codes and all the tax. Literally, they say if you print it out, it's going to fill a room, the entire room, with pages of papers. So that tells us how voluminous this topic is all about. So first thing I would like us to understand is that if you're in America working, making income, US citizens and permanent residents, you are taxed on your worldwide income. So you are obligated to report your worldwide income. not just the income you make in the US. In fact, there are two specific acts, one related to bank account reports, SBAR. That one talks about reporting your foreign accounts. If you have $10,000 or more in your foreign account, you're obligated to report that to the IRS. And the other one, which is the Foreign Account Tax Compliance Act, actually went further, not just reporting on your foreign accounts, bank accounts, you are obligated to report your assets in general. And that goes anywhere from your bank account to your foreign pensions, to your stock holdings, to your partnerships. So if you're involved in business interests overseas, you are also obligated to report those. Mutual funds, life insurance, and the whole lot of other things that you need to report. So there are some reporting requirements, of course, and money threshold and things like that that you need to keep in mind. But those are the things we can discuss with our clients on one-on-one. So just keep that in mind. The other thing basic that we need to understand is that there are two systems that are taxed: the individual or the employee, and then the corporation. Your understanding of this will help you to know which area you want to belong to. So for example, employees, as an employee working for somebody, you are taxed at least 5 times before you get your paycheck. So you have your federal tax, you have your FICA, which is the Social Security and Medicare. And then you have your state, some states, like you mentioned, some states and some locals also tax off of your paycheck. And then when you get your paycheck, you keep working on the taxes. So you have the sales tax, you have the property tax, you have the school district tax in some cases. So if you add all these percentages, that's where I came up with that number, about a third of your income goes to servicing tax obligations. So the other system is the employer, of course, which is the business, the corporations. In their own case, they are only taxed on the net income. So they get the opportunity to write off, do a lot of deductions, get even some credits, and then on their net, the bottom line. So you can be making $1 million and your bottom line says it's 50,000. So you're only taxed on 50,000. So those are big differences. So if you take nothing away from this seminar, try to understand that you need to know how you can transition from being an employee to being an employee on the corporate side of the equation. That way, even some of the daily expenses that you incur, you can transition those into a tax deductible expenses. All right, so the other thing basic is about tax computation, and then I put that there out because a lot of people misunderstood the concept of filing taxes and how tax is being computed. So people will walk into your office and say, are you able to make me money? Or some tax preparers promise to, make you money. There's no such thing. I mean, with expertise, you can help your clients to pay what they are required to pay, not more than. That's the purpose. But if you understand things that goes into the computation of tax, then you will understand that nobody is really making you money. If you plan well and strategize well, you should be able to pay minimum requirements. So the first thing is filing status. IRS has a filing status requirements. So if you're married, you have 2 options: married filing jointly or married filing separately. If you're single, you have one option, file as single. If you are single parents, kind of, or single, you have a dependent, then you can use the head of household status. Of course, there is also the qualifying widow as for somebody who lost their spouse and things like that. But the point I want to make here is that filing status really matters when people deceive taxpayers into, for example, husband and wife living in the same household. They promise you use your wife, your wife will use 1 case, your husband will use 2 keys. Each of you will file as head of household in the same household. That is a trigger for audit and things like that. So we need to understand that when you understand your filing status, then your worldwide income, like I said, goes into calculation. So where you compute through various forms to compute your income. And then you have your exemption or deductions. IRS allows taxpayers to deduct either standard or itemized. So you deduct the standard if you are not able to itemize your deductions. So standard this time around is generous to a lot of people compared to what it used to be, but that also compensates for exemptions. That you normally how many people in your household or dependents that you can exempt from tax. You don't do that anymore. You just take the standard or itemized deduction. Itemized deductions are things from your medical expenses. Of course, the medical expenses has a limitation as well. So I believe it's 7.5% now from 10% from 7.5. In other words, you are able to take care of your medical expenses up to the 7.5% of your AGI. So once you cross that limitation, the overage is deductible. Then you have your property tax, which is now limited to 10,000. So you can have property tax and sales tax and other local taxes of more than 10,000. The minimum, the maximum you can take is 10,000 from that deduction. And then you have your interest, mortgage interest. You have your charity contributions and other things that they call the below the line tax deduction. So when you compute all that, if it's more than the standard deduction, then you are favored to take the itemized deduction. So the reason I brought this out is a lot of people will come with, for example, charity contribution of 1,000, 2,000. They say it's supposed to be deducted. Until all this equates or is more than your standard deduction, it doesn't make any sense. So if you're married filing jointly, if your itemized deduction is less than everything I just mentioned, it's less than 24,000, you are better off taking the standard deduction, is the point I'm trying to make. So, so with that understanding, when you compute that, that is when you arrive at your taxable income. That's when you start looking at the tax rate. The tax rate graduates from 10% to, up to 33% or thereabout. So, yeah, so it graduates from 10% to about 39.6%. So, for example, 400,000 and above, 480 to be precise, and above goes into that 39%. So it doesn't mean that if you have for your net.
All right, I think we lost you there.
The next.
Okay, good.
Rate, and then until when you have your effective tax rate. So it doesn't go straight to tax you 39 of all your money. So we need to understand that. And then once you figure out what your tax is, the next is to compute what you have already paid by a way of your W-2 deduction withholdings. So all your estimated tax. So once you receive that, and then you add your credits for people with children under 17 and things like that, there is just tax credit. For low income earners, there is an income credit. There's a lot of other credits that goes into calculation based on meeting requirements. And then that is now when you determine, am I getting a refund, or did I not pay enough? Am I going to pay back? So this is what goes into the computation. So when somebody is telling you in advance without knowing your requirements, knowing your paperwork and things like that, and say, I'm going to make more money for you, make sure they are doing the right thing. All right, so moving on. I know we'll have questions at the end, so I'm just going to be trying to do as fast as possible to catch up with all the items we have here. So let's talk about the professionals kind of income. Now that we understand the basics things that we need to know about taxes, how it's computed. So I've mentioned employee. So that means you are working for the others. There's also self-employed. Some might be employee and have side gig, but they are not registered as businesses. So they make, sometimes it can be a hobby that graduates to making income, and then, to the extent that you are required to report it. So that's like a sole proprietors. Some are sole proprietors. They're not working for anybody, but they don't have the business registered. There's no difference between their business and themselves. And then we have the business owners, which is where I want to dwell a little bit about business owners. So you are working and then you also registered a business. So the problem is that most professionals who have a business, they have hard time understanding the compliance requirement for such businesses. And that is because of the structure they have in place. So you have LLC, you have partnership or professional partnership, you have corporation, and then you have opportunity to elect to be taxed as an S corporation. Most people don't understand all these structures. They just go ahead and register LLC, put their name, put the children's name, put their wife's name. The implication is that in Texas, for example, if you have LLC and it's you and your wife, you have the option to be taxed as the single member LLC. Other than that, by default, every other member on LLC is supposed to get a Schedule K1 to file their taxes. So they are members of you file partnership tax and then give them Schedule K1 to file their own taxes. So putting all family members' name on that means that you will give them, especially when you make income. So it's distributed according to partnership interest to all the members, and they are required to file tax with that. So that's one area that most professionals abuse or don't understand fully, not just benefiting those helping them with their taxes. But regardless of which structure that you have incorporated or registered with your Secretary of State, we have state and federal tax requirements for each of those. So for example, in the state of Texas, you pay, am I communicating?
Yes, we can hear you. Go on,
yes,
we can hear you.
Yes, go ahead.
So in the state of Texas, for example, you have the franchise tax obligation. If you trade on items that you sell, you have sales tax obligation. And if you have a payroll, of course, you have the state unemployment tax obligation. On the federal side, you have the corporate tax. Most people will register a business and they don't even file taxes. If you ask them, they said, I've not used it, I've not made money. For the fact that you already registered a business, IRS gives you an EIN, which is like your social security for the company, employer identification number. You're obligated to file tax. So filing tax is different from paying tax. So whether you make income or not, you still have to file tax. But paying tax is based on your net income. So if you have a net income, you pay tax on that. If you don't, then you don't need to pay tax, but the obligation is a requirement to file that. So, so professionals should understand different tax structures. And that is what we help our clients to understand, to help them structure their companies in such a way that they will minimize their tax savings. I mean, they will maximize their tax savings and minimize paying taxes unnecessarily. Okay, so I think what are we doing on time? Okay, so let's move on to the next, which is about tax savings, where we talk about deduction planning and the use of professionals. Yes, okay. Right, so on this issue, when it comes to tax savings, you know, there are a lot of noises about expenses or deductions. Not too many people talk about credits, especially when it comes to business taxes. So while deductions or expenses are very nice, they help you to reduce your tax liability. But the credits is a dollar for dollar on your tax due, for example. So let's say you have a tax due of 10,000, and then you have a credit opportunity to get a credit for certain items of 1,000. That will reduce your tax by 1,000. So you have 9,000 to pay to the government. Ordinarily, if you have a tax due of 10,000 and you remember, oh, I forgot to make a deduction, a certain deduction. So what that would do is to reduce your tax liability. So that 10,000, maybe if you compute it, it will reduce your 10,000 by 200. So that's the huge difference between deduction or writing off expenses versus getting credit. So what we help some of our clients is to identify some of those credits that they are qualified for versus focusing solely on business deductions or individual deductions. But I get many questions about what am I allowed to deduct or what kind of expenses do I do. So the general rule is that, first of all, if you have a business, it should be for profit. So your intent should be to make profit. Once that is established, you are authorized to deduct all expenses that are ordinary and necessary. That's the way they put it. So defining what is ordinary and what is necessary depends on the professional who is helping out on this. So what is ordinary to accountants might not be ordinary to doctors' offices or lawyers or real estate, but similarly, what is necessary might not be necessary to all this. So in your own area of focus, We have to define what is ordinary and what is necessary. As long as you have a fee incurred to generate income for the business, you are allowed to deduct such incurred expenses. The other thing most people neglect is research and development. Formerly, we think research and development is for factory manufacturers and things like that. Why that is true, but if you research into starting a business, took some training, took some things to develop the business, you are entitled to make those deductions as part of your tax. There's also capital expenses, cost of goods sold. Most tax preparers think cost of goods sold is for people selling inventory and things like that. But services also have cost of goods sold. So, and all this cost of goods sold and all that are deductions that you have even before arriving at your gross profit, before you start taking all the other operational expenses. So we structure our clients' account to help them get all these deductions. So as far as tax planning, we can't overemphasize on planning on your taxes even before the tax season arrives. So one of the things we help our clients is to help them plan. We look at their overall portfolio, overall financials, situations, and make sure that you avoid unnecessarily paying taxes that you weren't supposed to pay. So for example, we can help you get all the deductions and credits during the tax planning section to guide you there to avoid costly mistakes. We will be proactive in tax matters decision. So before you make any investment, you have to ask for the tax implication, and we'll guide you through that, and so that you can take advantage of some smart strategies that we put in place. So as far as tax planning, you can ask yourself some of the questions to make sure you are ready. First of all, you have to know your withholding requirements. So people fill out W-4 form to employers. W-4 will determine your withholdings. It will determine whether you are paying back at the end or whether you are getting a refund, among other things that we talked about. So you have to know your tax situation before you fill out your W-4 so that your employer can withhold properly. There are other things, questions to ask. You make sure you have maximized your retirement account. So there are provisions that allow you to put away some money before it's being taxed towards retirement. And there are some of your employers also match those contributions. So make sure you take the maximum matching. That will help you in reducing your taxes as well. You need to ask yourself if your investments are tax efficient. Also about charity contributions, there's a provision that helps a lot of rich folks save some tax dollars when they do charity contributions, especially when it's designated as a donor advised fund. So donor advised fund allow you to put away some money and you can direct, the specific use. But the good thing is once you dump that money, you can deduct it from that year and then spread it over several years of use. All right. So there are a lot of things that goes into tax planning, and but let's move to other fun, good stuff to know. where we talk about the audits, record keeping, and new tax updates. How am I doing on time? I believe I'm working according to the time.
You're doing good on time, sir. You have time.
All right.
Thank you.
Okay, so audit. There are about 3 types of audits that IRS conducts. They have the correspondence audit. They have the the field audit, and they have the office audit. So about 80% or thereabouts of the time, they will do the correspondence audit. That is when you get an IRS letter letting you know that we are reviewing your tax, or we are auditing your tax, or we recalculated your tax, and this is the result. If you agree, do this. If you don't agree, do this. So that is audit. On the extreme cases, they will conduct a field audit. In other words, they will send you some letters, communication, and then they will come to your office or come to your residence, wherever you decide to meet to look at in-depth activities of your finances. In some other cases, they will invite you to their own office where you can have a discussion with them. So these are 3 ways IRS conduct audit. But the question is, how do they pick people to audit? Most people think they are just victims and things like that. So I'm going to be sharing some triggers. But before then, let's examine how they select people for audit. So the first one is what they call matching program. Every W-2 you get, every 1099 you get, is reported to the IRS. So if you underreport your income, or they give you 1099 and you keep that away and report what you want to report, they have a way of matching what you receive versus what you report. And if it doesn't match, it is flagged for audit. I've had some business professionals, they have business on the side, and they give people 1099 and they don't know that they will report it to IRS. And people use the 1099 and file their own taxes. If it doesn't match with what IRS have, it's a trigger for audit. The same thing with W-2s. So when I talk about people making money, there's one popular, it's open record, IRS is aware of it. People can add, so let's say your W-2 is 700 withholding. Some tax preparers, being stupid, can add 0 to the 7,000. And because you overpaid, you now get a refund. And guess what? Once you submit your tax and they pass the initial check is the Social Security okay? Has it been used or this and that? Once you pass that check, you are paid. Now what happens 2 years later, 3 years later, you start getting letters that we reviewed your 2018 tax, and this is what is going on. So those are the things that we need to be careful of. So one is matching record, they match what they have with what you file. And the other one is what they call their district function scores. So if you look at IRS transcript, if you have received one, every line item has a number. So they compute using various queries. For example, they can say, show me taxpayer with such amount of income, but this amount of refund. And the system will fish out some groups of individuals. And then they will look at the score. So if your discrete function score meets their threshold, it will be flagged for audit. So they run various computation, various queries to generate those kind of audit selection. The other one is that you may belong to a targeted group. So for example, accountants are one of the targeted groups. They know you can write off some things. So they look at your own taxes. And most of the time they flag it for audit. So celebrities, artists, things like that, they belong to targeted groups.
Presidents or ex-presidents.
Okay, celebrities or ex-presidents, or some groups that they have known to be able to manipulate their taxes or take advantage of tax systems. So those groups can be targeted. It could be a tip. The other one could be a tip or referral from a neighbor or friend who sees your lavish lifestyle and has a revenue officer friend, and tip them to examine your books and things like that. In some cases, it can be bad luck. But in all this, there are about 150 or thereabout million taxes that are filed every year. And they can only audit as much. That's why it takes 2-3 years even for some people to get a letter about their taxes, because there are so much to audit. So, but if you're picked, you have options, you have rights. So make sure you seek the right option, the right. If you know what you're doing, apply your rights. If you don't know, seek professional help. But these are some of the things that you can do to avoid such. We call them red flags or audit triggers. So one of those is expenses or credits that are not associated with your business. So some people will make some credit because they have energy credit for so business. You went and apply it to your own, and it's not related to your business. So if you do such or make some deductions that doesn't apply to your business simply because you want to make deductions, those are red flags. Another one is large deductions that are out of line with the kind of income that you make. I said earlier, whether you make income or not, you still have to report your taxes. But if you make zero income and want to claim expenses of 50, 100,000, it might be out of line. It might be legit, but it calls for audit. So if they flag it, the onus is on you to prove, your expenses and things like that. So these are what triggers audit. Keep in mind, if you're being audited, it doesn't mean you are wrong, but they are right. So it's just for you to be able to prove yourself. Having more contractors than employees in your business. So they have a rule that defines who is a contractor or who is an employee. So if people try to run away from employment-related expenses, payroll expenses, and they choose to define people as their contractors so that they can deal with their own taxes. So in your business, if you have more contractors than your employees, that's a red flag. Claiming miscellaneous income is one of those. Chart of accounts allow you to select chart items where you can place your income. If you don't know what to categorize your income to, don't use miscellaneous, because miscellaneous can be anything. I've seen people write miscellaneous 10,000. They want to know what that miscellaneous is, so that's a trigger. The nature of your business can be a trigger. So for example, if you are reporting cash versus accrual method, and things like that can be a trigger to audit. So they encourage most businesses to use the accrual method. In other words, you perform your task or duty and then receive payment letter through a legit way instead of cash. Not to say that cash is wrong, but it's a trigger if you do a lot of cash transactions, because that's the fear that you may not report on. So under reporting your income, of course, I've talked about the matching program. Missing tax deadlines is another trigger. So if you can't meet the tax deadline, you file extension, that's okay. But if you miss your tax deadline, they might be wondering what you are hiding. That can be a trigger. I've discussed about targeted groups. Where you live can be a trigger. So if you live in Hollywood, for example, or if you live in poor neighborhood, they have been known to abuse the earned income credit. So earned income credit is if you make certain amount of low income, government gives you some credit. So a lot of people abuse that and claim what they are not supposed to claim. So those are where you live can be. And finally, if you have inconsistent social media posts. So for example, you put on your Facebook, you show your picture on Cancun on a boat flying around, and then you report tax of less amount, they will be wondering where is all the money coming from. So they look at social media. Yeah, so they look at social media and things like that. And you know, banks also report your transactions to the IRS. So for example, if you deposit, for those doing cash business, if you deposit 3,000 or more, it's an instant reporting on cash. If you deposit 10,000 or more on check or paper, it's also instant reporting. But overall, they report your transaction to IRS. So if you file your tax and they report the income, they have options to go to your bank and request for your statements and things like that, and try to collaborate it with what you are showing on your social media. So as far as record keeping, we encourage people to keep their records straight. They encourage you to keep tax record for 7 years, 3 to 7 years, depending on what the paperwork is, because IRS can go back. So they have 10 years to collect your tax debt. If they're not able to collect tax for 10 years, it passed the statute of limitation. So within that period, you are not off the hook. So that they didn't audit you this year or next year doesn't mean you are off the hook. We just pray they don't come, but when they come, they can go back. Most of the time they focus within 3 years. But if they find something within that 3 years, they can still go back and say, let's look at what happened 4 years, 5 years, 7 years. So you are required to keep your record. If you have a business, try to separate it from your personal. Get a bank account, do your business separately from your personal. And this is what we help our clients structure to do. So let's use the remaining of the time to talk about tax update, and then we can take some questions to meet up with other time. So I've already mentioned some of the updates, but you guys recall in 2018, there was a Tax Act, Job and Tax Act that our ex-president created. So that tax took effect 2019, and a lot of people must have seen the effect on their tax return, their 2019 and 2020 taxes. But still, a lot of people don't understand it, and they're still asking for the old stuff. So when we do seminar like this, we try to update and remind them about those. So of course, most of those laws favor businesses, which is another reason why you should be thinking about, if you don't have one, being an employer. So for example, the tax flat rate for businesses is now 21% compared to 33, 39% that it used to be. So regardless of what kind of business, big corporations. So they now default to 21%. Of course, if you're still a small business, your first 50,000 is still 15%. But other than that, any other thing is 21%. And also, the new tax law make provision for what they call qualified business deductions. So for pass-through entities, like you have an S Corp or LLC that can pass through your personal tax. So there's a provision to deduct 20%. Of course, there are a lot of computation that goes into it, but that 20% helps a lot of people, individuals. The big one among it is the one that allows you to expense up to 1 million. So we talked about capital expenditure. So if you use asset to generate income, you can deduct the full cost of that asset up to 1 million. I've had some people that ask me, I want to buy a car, can I deduct it from my business? If you buy that car to use for your business, of course, you can deduct the full cost of that for your business. So things like that. Up to the tax law, there's what they call 179 section that allows you to do some depreciation on that. But with this tax law, up to 1 million of expenses can be expensed doing that. And the other one that corporations like most is the alternative minimum tax. Individuals have alternative minimum tax as well. So, but the corporations one was eliminated with this tax rule. So what that means is, I'm an accountant, you are a lawyer or a doctor office. Because I'm an accountant, I'm able to write off some things, but you are not able to. So if we are in the same category of professionals and other people are making certain income and paying certain tax, even if I'm able to write off mine, I will be made to pay the minimum that those are paying. So that's what alternative minimum tax is all about. So those corporations are not required. So if you can write up to zero, you pay zero. So that's a huge deal with corporations. On the individual side, we talked about the dependent exemption. So prior to now, if you have 5-6 dependents under your care, you can exempt up to 4,050 as at 2017 or 2018 thereabout for each of those, but you start figuring your standard or itemized deduction. But right now, those are eliminated. There is no more exemption. To compensate with that, they bumped up the standard deduction, kind of doubled it. So, but still, you know, it favors some people, depending on your situation. It did not favor a lot of people as well. So that's one of the updates. As far as itemized deductions, the most affected area is what they call unreimbursed employee expenses. So formally, if you're a professional, you're working, you have a home office, things like that, and your employer does not reimburse you for those, you are able to deduct it. But now, you are not able to do that. It's been eliminated. Looking through my list, there's a lot of things like moving expenses, for example. Tax preparation fee used to be deducted. You cannot deduct that anymore. As an individual, companies can still deduct all this. State and local taxes, I've said it, you have a maximum of 10,000 to be deducted from your income. Child tax credits is bumped up from 1,000 to 2,000. And as far as child tax credit, a lot of people are going to be disappointed come next year, next tax season, Why? Because they are taking advance payment from July to December this year. Most people took the advance payment. They don't know the tax consequences of their when they file their 2021 taxes. They will expect that and they will not see it, and it's going to hurt a lot of people that didn't understand it. So, but it's increased from what it used to be, and there's also a limitation on who does that. So for couples making 400 and over, that is phased out for you. So there are some changes on health, but the most significant is on your, remember I said on your itemized deduction, you can deduct medical expenses. That is capped to 10 from 7.5. So if you make 100,000, you're supposed to pay, according to them, you're supposed to be able to pay 10,000 of your medical expenses before you can deduct. So if it's less than that, you're not qualified to deduct. On the education side, there's a lot of benefits, especially when it comes to the 5-9 savings plan, where you put away some money for your kids' education. So it used to be 10,000 per year per account, but now it's per student or per individual. So if you have 4 kids that you want to, you can make that 40,000 savings a year. And the other thing is that they expanded the use. So it's not institutional based anymore. It can be online, it can be homeschooling, can be buying books and things like that. So it's a huge tax saving material for some people. And then what else? The American Opportunity Credit that we're used to, they call it formerly Hope Credit. That one is eliminated, but they still have the lifelong learning and the American Opportunity Credit. American Opportunity Credit allows you to take credit for the first 4 years of college, which is capped at 2005. Anything after that, you can take advantage of the lifelong learning, which is 1,500 or thereabout. But also there are limitations and there are phased amounts that you can use. All right, so in summary, what this seminar is for is to help you, first of all, to know how to transition to things that can help you take advantage of taxes. So we urge you to, first of all, as part of tax planning, protect your identity. There's a lot of tax scam out there. You have to be aware of them, Some people right now cannot file tax until they receive identity protection PIN from IRS. That because their identity has been tampered. So that's one. Adjust your withholdings to make sure you know what your expectations are at the end of the tax year, whether you're paying back or you're getting a refund. Know the tax rules about foreign account. It's a big deal. Most people ignore this, thinking, how are they gonna know? Believe me, they know. They work with various banks around the world and they know all this. So know the rules that applies and follow it. Give to charity and take advantage of the tax break that comes with that. Maximize your retirement contributions. Take advantage of all the retirement, Roth IRA, traditional 401k, all those kind of things. Make sure you maximize your contributions to take advantage of tax. And then finally, we urge you to be smart. Use professionals. Don't be penny wise, pound foolish. I can do it myself. Some people do it themselves and do a great job. But if you don't know what you're doing, don't try, because most of the tax software that you use to do it yourself will ask you some questions and then you answer. Based on the answer, that is what they populate the next screen for you. But we don't go through the answers. We professionals, we know what you are required to do. If you don't answer well, you don't get the screen that will allow you to do things that you need to do. So we encourage you to use professional to do your service. So we are here to help. With that, I can take some questions, and thank you for listening.
All right, well, that was awesome. Thank you very much, sir. We really appreciate your time. There's a lot of questions. But let me just say thank you. Mr. Adeleke Oyelade, thank you very much, sir. I will be throwing questions to both of you. So for those listening, thanks for staying with us. Mr. Adeleke works with Mr. Ben. They are both partners in JSG Arnold. So they can answer the questions together. So one of the first questions I have is, what are the pros and cons of a newly married couple filing separately versus filing as a couple?
All right, so let me start by saying that filing status, married filing separate. There's no benefit to that, except that they made that filing option for people that want to keep their finances separate, basically. You don't take advantage of any credit, education credits and income credit, all the credits that we mentioned about. If you are doing the filing separate option, you don't take advantage of that. So the only benefit is that you are able to keep your finances, track your finances separately from your husband or your wife. If you want to take advantage of tax savings, the best option for married couple is filing married jointly.
So meaning when you file as a couple, you get more tax savings?
Yes.
Okay, good.
Than filing separately, yes.
So if you're on this webinar, if you're not married, you see how you can save money. Go and marry. That's all
yes.
Just kidding. All right, I omitted everybody so that you can ask questions, but let me quickly run through the question in the chat before I throw it to the house. And I have a couple of that questions that was sent to me too. So let's run through it. What is the difference between tax filing planning and tax strategy planning? E.g., using S Corp and estate planning implication on inheritance taxes. Yes, this is a lot of questions. Did you get the question?
So they want to know the difference between tax planning?
Yes, and tax filing planning and tax strategy planning.
I don't know the difference, but what I can say is both are strategizing about how you can make tax savings. So whatever name is being called, I don't know what it is, but if it's based on what I have just said, you can plan towards your taxes ahead of time. You don't need to wait until January when the tax is opened for filing that you start running around. So you have all year to plan even your purchases, your assets, your investments until the tax day. And when you do that with a professional, that will give you some advantages over others.
Okay, can I just throw more light into the question? Can you give me like 30 seconds?
Go ahead.
Yeah, so the second one actually is what I was asking for with respect to, for example, the type of corporation you use as a vehicle and the tax implications. Like, for example, if you're using an S Corp or you're using things that you're going to bequeath stuff to your kids later on, there may be some kind of either inheritance tax or something that the government takes a portion of it from. How do you, so looking long term, is that slightly different in terms of your own approach, what you call it, in terms of how you can manage that vehicle of investment or that vehicle you use to do business compared to just, I'm an individual, you know, we are couples and we want to sort of manage how we are going to file for next year. What can we do to optimize our tax savings and minimize what we pay to the government with respect to tax legally?
Okay, I get that. So estate planning is a different thing altogether. That's what you're talking about. And tax planning is also a separate thing. But as far as using S Corp or corporation, that may not, depending on the structure of your company, if you want to hand over a company to, it doesn't have a lot of implication. What you should be concerned is how much am I able to pass through my generation? For example, the new tax law actually increased that amount. It used to be 5.6 million or thereabout, but now you can transfer up to 11 million without tax consequences. So that's a lot of money that even a lot of people don't worry about now planning for estate, because if they, before you can get to 11 million, it takes the grace of God, but a lot of people have that. And they made it in such a way that you and your wife can actually do 22 million to each of your dependents. I mean, each of your kids or your generation. So because they have widened the gap, estate planning is still there, but it's not something that you need to worry over a long time using your corporation, because there could be other things that you can do. So while talking about S Corp, I also want to mention that most people register a business and default to elect to do S Corp without knowing the kind of income they will generate. So if you have an LLC, for example, and a single member or husband and wife in Texas, that can pass through your personal tax as a Schedule C. If you are losing on that, it will help your tax. If you have a net income versus net loss, net income will increase to your tax liability, but net loss will also help in your overall tax. The difference between that is the self-employment tax. Why people rush to S Corp is to avoid the self-employment tax. So if you, depending on the kind of income you will generate, you might be favored using S Corp versus LLC. So, but there's a lot of computation that goes into it that, you know, we'll not have time to discuss here. But if you're looking to that structure, we can help our advice better.
All right, Kes, I would recommend you go talk to JSG Arnold LLC after this program. Moving forward, are bank accounts audited?
Yes, that's the first thing they do. Once you are under audit and you cannot satisfy them through the correspondence that are going on, they will request for your financial statements, bank accounts, yes. And because they already have it even before they ask, remember I told you banks report to IRS and things like that. So it's audited. Okay. So once you are under audit, everything your finance is being audited.
All right, guys, don't go and put your money under your pillow or your bed. Put your money in the bank so you can invest it in real estate or Bitcoin. All right, moving forward. How can we use 529? Please hang in there with us. We have some questions, and I'm pretty sure it addresses each person in different ways. So the Q&A is good to educate ourselves. So please bear with us. How can we use 529 or collect savings for tax? Are there income limits?
So 529, my understanding is that you put, so if you have, if you are W2 or you're an employee, before they pay you, remember I said they take out some taxes, right? Before you get your check. Before you get your check, you can move some money to the 529 account. Right now it's 10,000 per year per account, per individual, not per account. So account means me signing up for 529, but individual, I have 4 kids that are school bound in my household. So each of those, I can save up to, I can put in up to 10,000 for each, which is 40,000 that are not taxed. So that's the advantage. It's pre-tax money. And you can use it for their education or extracurricular activities and all other host of things that they expanded. Before, it was strictly when they are college bound, you pay it to the institution or use it for that, or you pay the tax that you refuse to pay early if you withdraw it. But now there's a lot of things that you can use it for. So it's a good tax savings that you can do. About the income requirement, I'm not sure what the income requirement is. What I know is that you can put away 10,000 for 1 year.
All right, thank you. Oh, wow. If you are not following, let me wrap it up quickly. Mr. Ben is telling you that if you are married, you save money on tax. That's the first thing today. Secondly, he's saying if you have more kids, you can also save on tax, 10,000 per child. So once you get married, you don't have more kids again. So that way you are saving money on tax. Just to summarize today. All right, we have 3 questions on the chat, then I'll open the floor for everybody. Is it better to represent yourself as a company or a business when doing a consultancy role or job as a personal entity? That's, when you get a contract job, is it better to represent yourself or is it better to go to the company? I think they call it W1019, I don't know what it's called, cop to cop or something like that.
Oh, yeah. So my understanding to that question is, let's say you have a business, right? Is it better to take a contract with the business name versus your individual name? Is that what the question is?
Yes, that's it.
Yes, and the answer is yes. It's better to project your business, use your business. So the implication is that some companies actually, when they contract you, offer to pay you W-2. What that means is they will deduct your taxes before they give you your check. Versus when you use your business, they will give 1099 to your business. Some businesses actually don't need 1099. So you report your income, you do all expenses associated with the business before you can pay tax on those. So there is a huge advantage of contracting through your business versus you as an individual.
All right, thank you. The next question is coming from a professor because you will know it's very long. So it's a prof, she's a prof. If you did not file a Schedule K1 as a part business owner a particular year, do you file that the following year? Question mark. What if one business partner filed only one K1? How does that affect the other members? I can read again.
No, I do understand the question.
Okay.
So if you, if you're a business owner that is expecting K1, it's just that you are expecting W-2 from your employer. So if you don't file, what it means is underreporting, except if it's to your advantage. Let's say you have loss from the K1 or something. So, but to answer your question, you can always make an amendment to your So it's better to make an amendment. It doesn't need to, you don't need to wait till next year. If it's next year, you can't put it in your next year tax. You still have to amend. Let's say you missed for 2020, and then it gets to 2021. You can't put your 2020 K1 on 2021 tax. You still have to amend your 2020 tax to accommodate that missing requirement.
All right, thank you. Last question on the chat before, I think, no, one more. What are the tax saving strategy or options available for IW income earner, like say over 1 million? I mean, who will be this person when they make 1 million? All right, just joking. What are the tax saving strategy or options available for IW to income earners? That I actually have that as a question too, but go ahead, sir.
Yeah, so W-2 earners that makes 1 million on their W-2, right?
Mm-hmm.
Yeah. So, like I said, if you're an employee, regardless of how much you make, they already determine what your withholding is. They withhold your money and they give you whatever is due. When you file your tax, government will factor in what you have already withheld, and if you are required to pay back or get a refund. If you want to save money, you can diversify, be an employer, open businesses. So most people most people come to the office, they use the ex-president as an example and say he's taking advantage of taxes and that. Do you know how many high-rise rise buildings that he has? One depreciation on one of those buildings can knock off his taxes. So those are the kind of advantages. So when they say he pays how much as a president, salary of a president is 400,000. Depreciation can knock off that and make you pay later. Imagine you depreciating 150 million house building, and he has how many of those? So when he says he's taking advantage, it's what the tax law provides. So if you do the same thing, you are able to take advantage of that. So invest wisely. When you file your tax, it brings all your worldwide income, remember? So, and some of them can be to your advantage. If you lose on some areas or some businesses, it can knock off some of the taxes that you would have paid through your W-2. So those are the kind of things we can discuss privately.
All right, good. Last question on the chat, so I can open it up. Do IRS tax money invested into charity or NGO? I think you don't invest in charity, but I'll let Mr. Ben take that.
Yeah, so they don't tax money. So for example, if you are a nonprofit organization, one of the things you need to do is to get an exempt status. So you file IRS to get exempt status. If it's charity, you do the 501c3. If it's social club or other things, there are other exempt status that you can claim. So what that means is, even if you have income for that organization, as long as you are using it for the purpose and you don't have unrelated business income, that organization is not taxed. You making the donation to that organization is able to deduct it from your tax, because you are helping the government solve some of the problems that they would have solved for the society. You are helping, so they allow you to take advantage of that, deduct those from your own income. I mentioned about donor advice fund, which is one of the charity savings that most rich people do. They create a foundation, put huge amounts there that they can deduct from their taxes, and they direct on how those funds can be used. They can employ people on their charity, their loved ones, to run it, get paid. By the way, that you are charity and nonprofit doesn't mean you don't make money. You can make money and pay your employees and then use the fund for the purpose of the charity. So if you are thinking of creating one foundation for yourself and want to put money, those are called private foundations, and there are rules regarding to that. For example, you had about Bill and Melinda Gates Foundation, for example. Those are kind of private charities. They put huge money there that can deduct, and they use that fund to do some other things that can benefit them and the public.
Awesome, thank you, sir. Our time is fast spent, but I know it's tax questions and it's very important because I have high income earners here, like 1 million. Jesus is Lord. Let me open the floor. If you have any question that has not been asked, already, I would like you to, speak up. If you are not, if I didn't unmute you, just signify and I will do that. I want us to wrap up quickly. I have like 3 or 4 questions I would like to ask Mr. Deleke and Mr. Ben to wrap up. So anyone with any questions that has not been asked already? Anybody? All right. When we
Sir,
have that,
maybe I just want to comment on the non-profit that my partner just talked about. Generally, people don't take advantage of this. We have some of our clients that are into IT and various professions that are making huge income. And at the end of the year, they always faced with crisis on where do I put this money? How do I not pay so much? Which taxes? Like somebody paying over $80,000 tax and it's disturbed. So the advantage of having a non-profit is very important for them. And on this field, the explanation is to the minimum that we could, is what he has explained to you, in the sense that when we meet with you one-on-one, we can guide you on other aspects that will be able to help you. But people should take that advantage of setting up a non-profit, because the challenge is, give it to churches, give it to mosques, is important. But generally, people don't give enough for them to enjoy the benefit of non-profit. Because beginning with the new tax law, for you to be able to have any, if you are filing as individual, you must have given as much as $12,000 if you don't have any property, for you to be able to have itemized deduction. If you are filing as head of household, you must have given as much as over $18,000. If you are doing married filing job, you must give as much as $24,000 if you don't have property and other expenses that you can itemize. But when you have non-profit, this could help you. Thank you.
All right, thank you very much, sir. That is good. Let me run through these questions quickly. How does the recent child credit payment affect tax return? I've had a few friends reach out like, hey, I get this money. The money has not been consistent for some reason. Sometimes it shows, sometimes it doesn't show up. How does that, I think you mentioned that already, but how does that affect the tax return by the end of this year or next year, March?
Okay, so when you file your taxes, I've talked about credits. Credit helps to reduce your taxes, as well as some are refundable, some are not refundable. So for example, if you owe 10,000 and you have non-refundable credit of 1,000, it will go ahead and reduce your tax by 1,000, so you pay 9. If it's a credit that is refundable, that means regardless of what you owe, you still get your credit. So child tax credit is one of those, and it's people are, if you have a child under 6, I believe, it's 300 that you are getting in the mail. If you have a child between 6 and 17, not 16 or under 17, you get 250. Some people are getting this check, some are not getting it. So it's called advance. And they want to use it to help people through this corona pandemic period. So if you get it, whatever you get will be deducted from your 2021 tax. If you don't get it, you can still claim it. So it's going to hurt a lot of people because they have already taken the advance credit, and what they are used to is to use some of those credits to help them reduce their or pay off the tax they will owe. That is not going to happen if you get advance. If you haven't gotten anything, then you're still good to go. So I don't know if I answered that question. The impact is either you have taken the advance or you have not. If you took advance of it, don't expect to get it next year.
That's like saying you're already eating your cake, so you cannot have it again in March.
Exactly.
Okay, so please take notes, friends and family.
Yes, let me add a little point to that. Another problem that people are going to face generally is that in the computation of this advance payment, IRS is not going into detail as to the income brackets, because the law passed for this tax credit has some limitation based on the income. So it's possible some of the people that have already taken some money now actually go to pay the money back beginning of next year when they are doing their taxes, because it came with some tax implication and some limitation about the income bracket. So people should take note of that, that if they ask them to pay some money back based on the tax credit they have obtained, that's what led to it.
Yeah.
All right, thank you, Mr. Adeleke. That was good. Let me combine these two questions together. You've answered it already, but just for the fun of it. How can we pay less tax legally, in brackets, like Trump? Someone said, what are the legal steps high income earning people can do to avoid paying taxes during tax return? So I think somebody asked that question. So I'm just putting it together. I think that's two questions in one. So how can we pay less tax legally, like our ex-president?
Okay, like you said, I've answered it before. Do what the ex-president is doing. Expand on your investment, build a lot of things. So if you're in real estate business, for example, one of the advantages is this thing called depreciation. Depreciation is not, you did not expense, do any money did not go out, but you are getting benefit of it. So if you have a house of 400,000, for example, you are allowed to depreciate it over 27 years. If it's an investment property, you're allowed to depreciate it over 27 years. In other words, every year, even if you go through the straight line, you can deduct some of those money on your personal taxes. So imagine when you have 4, 5, 6, 7 of those. I mean, that's a lot of deduction for you. So invest wisely is general counsel for that. But if you need more detail, we can meet one-on-one and discuss about it.
Awesome. Thank you very much. Just quickly, I have like 3 more questions, then we'll wrap everything up. So I know our time is past 10 today. Please bear with us if you're still hanging in there. You've mentioned this before, but I'll ask this question again just for the purpose of clarity. Online tax filing versus using a real tax preparer. What are the advantages and disadvantages? TurboTax, HR block, all those advances that they bust on you when it's tax time.
Yeah, so I mentioned it before. So those type of software are structured to ask you questions, believing you know the correct answer. So in most cases, you don't know what you're answering. And then if you answer question 1 correctly, it moves you to question 2. If you don't answer question 1 correctly, it would default to another page for you. So basically, it's prompting you to do your tax based on AI or artificial intelligence, right? Being artificial is not real, versus when you meet a professional who you will work with one-on-one and will advise you and will not look at the prompts of the screen. So I have had a lot of people come back. By the way, one of the things we do is to review. Some people will bring their taxes and we have the opportunity, if it's a first-time customer, we can review your tax for the last 3 years to see if there are some errors and we can amend it. And so we have found some people that use TurboTax or some other tax software to do it themselves and miss out on some of the things that they should have gotten benefited from. So my counsel is, if you know the answers, if you think you are doing, it's an open knowledge. If you know it very well, go ahead and do it yourself. But if you don't, please seek professional help.
All right, thank you very much. One last question before I ask each one of you one question to wrap it up. Mr. Ben, can I claim tax return or tax deductible if my tenant doesn't pay rent during this pandemic?
Okay, so during this pandemic, I think there's a provision that allows tenants to require landlords not to evict their tenants even though they are not paying and things like that. So as a business owner, you must have taken some advantages of all the business credits that government provide to help with that that issue of not paying the rent. Yeah. So if they don't pay rent, you don't report income. That's number 1. So in the tax software, it asks you number of days available for rent and number of days that you did not rent it, even though they are available. So answering those questions will help this. But if they don't pay, you don't report income. If you make any expenses, even though you didn't report income, you are still entitled to claim it.
All right, thank you very much, sir. All right, to wrap it up, Mr. Adeleke, if you can see your face, that would be great. But if you're driving, if not, that is fine. I want us to elaborate a little bit. Tell us more about your business. That is JSG Arnold. Like I said, Mr. Adeleke and Mr. Ben, they are both co-owner of the company. So I've met both of them before. And just to let you know, I do my taxes with JSG Arnold. So I highly recommend them. So Mr. Adeleke, tell us about your business, especially as regards small business owners, LLC, sole proprietor partnership, helping people with setting up accounts to run their business. Can you elaborate more about what the company does so that people really understand, what's JSG Gold? I don't know why I keep calling it Gold. JSG Arnold, it's all about. Thank you, sir.
Yes, thank you very much. Basically, we are one-stop solution company to business services. Our operation is basically on financials, doing income statement for companies, helping business to register their business transactions and all that, and do their taxes. But like Ben explained on the area of tax planning, we help companies to plan from the beginning of the year, during the year, as to what they can do with their businesses in such a way that it will not give them so much tax liability at the end of the year. Then we also help business to structure their business in such a way that we'll be able to take all necessary advantage. The bottom line is for you to make profit. So we guide you on things you need to do that will not make you run foul of government laws, and at the same time, make you to be able to run your business smoothly. In terms of business registration, I'm advising on the business formation, on the kind of financials you need to keep, on the kind of savings you need to do. Those are the areas that we do. I mentioned the issue of for non-profit initially. We are doing a lot on that nowadays, helping most of our clients to ensure that we are able to obtain 501c for them. 501c is what allows you to be able to claim all those deductions for non-profit. And it's not just, you'll be amazed that even some of the churches that you pay that and offering to do even have that registration, or they are already been foreclosed, because there are guidelines on how to maintain those licenses and all that for you to be able to make deductions. So we're able to advise our clients on those areas. But basically, we do financials and taxes, and we also help in business formation and give advice on investments. That's what we do all around.
All right, sir. Thank you very much, sir. That was good. And one last question, Mr. Ben. Interesting. Tell us, can you explain the titles that you have? I think I know MBA. CISA, CFEEA. Tell us all this knowledge so that people understand, what it means, and maybe it might give more clarity to who you are and what you do.
Okay. Yeah, I mean, a lot of titles. For the purpose of this seminar, if I know this will come in this way, I will only have EA, because that's what satisfies. That's what satisfies this seminar. EA is enrolled agent. It's one of it's the highest, not certification, so to say, license or something that IRS can grant tax professional. It's exhibit of your knowledge about IRS tax issues. So enrolled agent, most people think CPA is everything, but not to malign CPAs, but I do taxes for most CPAs, their personal taxes. So CPA mainly is required for companies that deals with Security and Exchange Commission, public company. That's why they call it certified public accountant. So if you're auditing public company, they require a CPA signature to say that the company is in compliance and things like that. So I'm an enrolled agent, that's EA. Certified fraud examiner is a title that deals with fraud investigation and things like that. CISA, Certified Information System Auditor. And I have a lot of other certifications that are not relevant for this, but I mean, those are things. But as far as what we do, my partner have explained all that. I forgot to mention payroll, which is one of our core things. We do payroll for small businesses. And, you know, especially this time, payroll is a big deal. There are some companies, professionals that have business, they just got to check for themselves and think they are running payroll. That's not how it's supposed to be done. We help them structure their payroll in such a way that they can take advantage. And if they are paying people with payroll, for example, the PPP things, a lot of people miss that because they don't have structured payroll on it. So we help companies with that. Your accounting, bookkeeping, taxes, and tax resolution is another important factor, not just the preparing of tax. If you have an IRS issue, we help represent our customers on that.
All right, sir. This has been great. Thank you very much. I have learned a lot. I've seen people reach out to me that they've learned a lot.
Can I ask a quick question? Sorry.
All right, go ahead. I was about to wrap up, but go ahead, Sean.
Yeah. Is PPE, is it PPP and PPE, is it still ongoing right now in any states or still, you know?
No, not to my knowledge. PPP, which is a payroll protection program, we have exhausted the fund. So it's no longer available for now. What is actually happening now is the applying for the forgiveness of those funds. So that is ongoing. Depending on when you receive yours, we're still helping our customers to apply for the forgiveness of those funds. But some states, my knowledge is that some states are still helping businesses on various areas regarding the coronavirus pandemic.
All right, thank you very much. Let me wrap it up. If you want to learn more.
Before we wrap it up, sorry. Do you guys assist with people outside of Texas? I think I asked that. I don't know. Do you guys?
Yes, we do.
Okay.
We do.
Yes, they
Thanks,
do.
Larry,
When I started working with them, I was in Atlanta, and as you all know, I'm in Texas now. So, but when I joined them when I was in Atlanta, and you know, it's been a smooth transitioning for help working with them on my taxes. All right. If you want to learn more, please visit JSGArnold.com. That's why I purposely left the screen there so that you can capture the phone number. You can email ben.azunna at gsgarnold.com, and the phone number, I think it's either the direct or the office phone number. All right, to wrap it up, you know, thank you very much for today. The webinar recording will be posted on our website or our YouTube channel at Blooming Edge. I will probably get to that tomorrow. Join our mailing list. If you want to learn more, you want us to, you know, get information out to you, invite on our webinar, please drop your email in the chat box. I'll get it from there so that when we have our seminar coming, we'll let you know. We have our last seminar for the year next month. I'm taking December off to recoup, to understand what is happening again. So next month is our last webinar for the year, and it's going to be talking about, I think, property management, long distance property management, something like that, from Sandra Iziguzo. All right, with that, thank you very much, everybody. Reach out to us, connect with us, Blooming Edge Group on Facebook, Blooming Edge Group, Instagram. We have Twitter. We are active on all social media channels. Mr. Ben, thank you very much. Mr. Adeleke, it's been wonderful having both of you. Thanks for the past 2 hours speaking with us and answering all our questions. And to everybody, thank you very much. If you like my t-shirt, I got it at Walmart. Go grab one. Thank you. They've been asking me about it a lot. Everybody have a wonderful night and enjoy the weekend. Thank you. Bye.
Thank you. Mm-hmm.
Thank you.
Thank you, everybody. Take care.